Are you an investor looking for long-term capital appreciation, but worried about the short-term volatility associated with innovative companies? Well, you're not alone. Many investors appear to be afraid of companies that offer newer, faster, cheaper, and creative products and services. Now, you can avoid these innovative companies. How? Ask your advisor today if investing in a traditional broad-based index is right for you. A broad-based index provides investors with a feeling of safety and comfort, knowing that they hold past success. Often based on tangible assets like a bank branch, railroad, or real estate, indices should generate predictable cash flows because, hey, that's historically been the case. And things never change. Side effects may include, but are not limited to, owning companies associated with the traditional world order. Investors holding stocks associated with traditional transportation, banking, bricks and mortar retail, and linear TV may experience headache, nausea, and increased blood pressure due to the accelerating threat of disruptive innovation. Your investment portfolio doesn't need to be bothered by a changing world. This parody was brought to you by ARK Invest. To learn more, download Bad Ideas at arkinvest.com/badideas.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, we're taking a look at ARK Invest Bad Investment Ideas report because, well, we're here to make money investing, not lose it. After all, if you lose money investing, that makes you a loser, right? Get it? Loser. Anyway, let's get into the video. But first, hey guys, if you're in the US and you'd like 3 free stocks, yes, 1, 2, 3 free stocks, check out the link in the description to WeBull. Open a new account and fund it with $100 and you'll get 3 free stocks, 2 of them valued up to $1,600. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it. So here we are, the ARK Invest Bad Ideas report. The industries that could be disrupted by innovation, published October 14, 2020. Let's have a read here. The ARK Bad Ideas Report 2020. Today we believe the global economy is undergoing the largest technological transformation in history. Disruptive innovation should displace industry incumbents, increase efficiencies, and gain majority market share. As technologies emerge and transform entire industries, investors in traditional benchmarks may face more risk than historically has been the case. Now, this is a very, very, very important point. Many investors out there have the mindset, oh, it's really safe, just invest in index funds, etc. The point ARK are making here is that strategy going forward is likely to result in massive underperformance because these indexes don't account for disruptive innovation. Based on our research, we believe investors should evaluate and avoid the following bad ideas. 1. Physical bank branches. 2. Bricks and mortar retail. 3. Linear television. 4. Freight rail, and 5. Traditional transportation. Physical bank branches. Now before I get into this part of the report, let me know in the comments below, when was the last time you personally actually entered a bank branch in person? For me, it's been over half a decade. The only reason I had to make that entrance to the bank branch at all was because I won a competition. They sent me the prize money in the form of a check, which I literally had to go cash in person. Get with the times, guys. So let's read on. Physical bank branches. The internet and smartphones are transforming the distribution of financial services. Thanks to cellular services, we believe smartphones are distributing financial services much more efficiently and cost-effectively. Digital wallets, bank branches in user pockets, are rendering expensive physical infrastructure useless, putting at risk hundreds of billions of dollars of traditional financial institutions' assets. Finance and insurance accounts for roughly 8% of GDP in the United States and 10% of the S&P 500's equity market capitalization. In other words, approximately $3 trillion in market capitalization is facing the threat of disintermediation. Consumer banking is shifting from brick and mortar to digital and mobile. Well, no shit, ARK. I mean, thanks for pointing this out, but you really do need to be a dullard not to have figured this out. But let's look at some of the implications and some of the data. So we can see here, customer growth comparison, Wells Fargo, Chime, Cash App, and Venmo. Around Q2, Q3 2018, Venmo passed in terms of user growth, and then Cash App has done the same thing in Q4 2019. We can see this trend now. These digital wallets, more efficient ways of doing your transactions, your banking, etc. are absolutely taking over. Of course they are, because it's more convenient, it's cheaper, it's better for the customer by an enormous margin. So of course people are going to adopt this new, better, superior way of banking. We believe the main reason for the explosive growth in digital wallets is lower customer acquisition costs. Compared to the $1,000 on average that traditional financial institutions pay to acquire new customers, digital wallets invest only $20 thanks to their viral peer-to-peer payment ecosystems, savvy marketing strategies, and dramatically lower cost structures. Now, I hate to point out the obvious here, but I will. The cost burden that branches place on traditional banks is increasing while their utility is decreasing, and we can see this cost graphed out here. Why on earth would it make any sense to hang on to these relics of the past that are extremely expensive and basically useless now when we can do the same things from our mobile phone or our computer without having to move our meat sack to another location, aka the physical branch? And why would traditional banks be hanging on to these retail locations when it's bleeding them dry and adding no value to the customers? Exactly. Rip the physical banking industry. 2. Brick and mortar retail. Now, just going to take a quick pause here to ask you guys a question. Are you noticing a theme already? Yeah, that's right. Physical stores for companies selling items and products and providing services that can now be accessed more conveniently digitally are all categorically fucked. Let's read on. While in-store retail sales in the US peaked in 2015, the coronavirus pandemic has accelerated the shift to e-commerce. Last-mile autonomous delivery could provide another boost, making e-commerce much more cost-effective and convenient. In our view, companies with large retail real estate footprints will continue to suffer from a decline in foot traffic. And in my view, I completely agree. If you own commercial real estate, if you own traditional bricks and mortar retail stocks, etc., I would be very, very, very cautious and really consider whether or not they're likely to deliver the returns you're expecting in the coming years. E-commerce is accelerating. The coronavirus pandemic has accelerated the adoption of e-commerce in the US from 11.3% of retail sales at the end of 2019 to 16.1% in the second quarter of 2020, the largest quarterly jump in history. In our view, as a percent of retail, global e-commerce will quadruple from 16% in 2019 to 60% in 2030 as drones add to its convenience. As a result, retail real estate values are likely to suffer. I completely agree with this. As e-commerce continues to grow because it's better, cheaper, faster, more convenient, etc., traditional bricks and mortar retail companies are in big trouble. Time for a quick story. 20 years ago, this guy, with a few more pimples and a little bit less hair, was already using Amazon to import books, electronics, and other things because this guy had access to the internet, and this guy also knew how to use a calculator, and this guy realized that it was much cheaper, not a little, much cheaper to import things from the United States and sometimes Europe than to buy them locally in Australia because we have crazy import duties, all sorts of high taxes, blah, fucking blah, blah, blah. The point is, it has been painfully obvious for multiple decades that e-commerce absolutely shits all over bricks and mortar retail. Pop quiz, which stock makes up the second largest position in my stock portfolio behind Tesla stock? And the answer would be, drumroll please, Amazon stock. Yeah. Enough said. ARK estimates that roughly $2 trillion in enterprise value is at risk in the public equity markets across the retail categories with heavy real estate footprints. While some companies will transition successfully to an e-commerce model, ARK expects more bankruptcies during the next 5 to 10 years as not every business will survive or cut retail assets quickly enough. I completely agree on this. And just one very interesting note here in the charts. Look at this retail square feet per capita. Completely flatlined before 2010. This is a sign that e-commerce now is overtaking traditional retail. The question is, why on earth isn't this plummeting off a cliff and everybody moving to e-commerce? That's right, because they prefer to go bankrupt in the next 5 to 10 years. Let's watch it play out. 3. Linear television. Linear television is real-time programming accessed over the air or by cable/satellite at scheduled times. While the primary delivery method of live programming in the US today, linear TV is giving way to over-the-top services that deliver on-demand and live programming via the internet. Time for another story. In 2004, when I was 19 years old, I moved out of home to another city to further my studies. I consciously decided not to buy a television to furnish my new apartment, and I've been without a television since, over 15 years. My rationale at the time was, why would I open my mouth like a fucking baby and be spoon-fed my entertainment and information when I can go and seek out what I want to know on demand on the internet? Yes, I am an OG internet user. I've been using it since 1993. This is 11 years later, and by that point in time, I'm like, Why would I sit through ads I don't want to see, content and opinions I don't want to see, and have to do it on a schedule? What is this? The internet's here. By this stage, you guys may be noticing a little bit of a trend here. My personal actions as a consumer have been providing clues to potential investments, you see. Linear television sucks shit. The internet on demand is where it's at. Fancy that. Next minute, Netflix. Retail sucks shit. Buying online is cheaper and more convenient. Next minute, Amazon. You understand where this is going, right? We believe that the $442 billion in linear TV subscription and advertising market capitalization is ripe for disruption. Streaming services are driving cord cutting. Starting with Netflix, the proliferation of on-demand viewing services has changed viewers' perceptions of linear TV. Paying for 1,000+ channels, 90+% of them never watched, now seems ridiculous. Not only is Netflix providing content at a 70% discount to cable providers as shown below, it, along with other streaming services like Disney+, HBO Max and Amazon Prime Video, match subscribers with specific content thanks to AI recommendation algorithms. We believe the better economic value and user experiences have paid off, so much so that linear TV providers are now suffering from cord cutting at an accelerated rate. Here's a great visual representation of what's going on. We can see the disruption of print advertising here, the dollar spend falling off a cliff, and the US linear television advertising revenue also falling off a cliff. And where has that advertising money gone? Bingo, right here. Welcome to the new world. In conclusion, given its declining subscriber base and the plethora of new streaming options, we believe the end of linear television is not an if, but a when. I completely agree with ARK here, and in fact, I'll take it one step further. I've been asking myself the question now for well over a decade, why on earth anyone who doesn't have serious problems with their mental faculties, and I don't mean this as an insult, but a statement of fact. This is something that I have wondered. Why anyone who isn't mentally impaired watches linear television. I just don't understand. Do people prefer to sit through ads for products they don't give a shit about and have to watch television based on regularly scheduled programming instead of on demand? Do people really prefer to have a limited selection of content rather than seeking out that which they want to see, watch, learn, and know? I don't get it. I really don't get it. Number 4, freight rail. I'll save you guys a little bit of time here. This one is pretty simple. Over time, autonomous electric trucks are going to completely disrupt rail transportation, as we can see here with ARK's estimates around cost per ton mile. Look at this. Autonomous EV truck, 3 cents per mile. Cheaper than rail, way cheaper than human-driven trucks, way cheaper than air, and marginally more expensive than a barge. Of course, you're never going to compete with the economics of a gigantic fucking ship floating across the ocean. And one final point here from ARK. The public rail industry accounts for roughly 12.5% in the S&P 500 and is worth $760 billion in total US public equity enterprise value. We believe during the next 5 years, autonomous electric trucks will commercialize and take share from rail operators with more cost-effective door-to-door service. If autonomous vehicles proliferate into various form factors, including flying drones and rolling sidewalk robots, we believe freight rail companies will have trouble competing with antiquated technology tied to dedicated infrastructure assets. ARK wonders which, if any, freight rail operators will survive. And now the moment you've all been waiting for. 5. Traditional transportation. Robotaxis could reduce the cost of point-to-point mobility discontinuously in the US, stealing $150 billion in annual demand per year from ride-hailing, short-haul flights, and public transit. If robotaxis become the dominant form of urban transit, ARK expects US auto sales to drop from 17 million units today to roughly 10 million by the end of the decade. We believe robotaxis will upend the market for traditional auto insurance, cutting annual premiums in half, and will disrupt the auto loan market as the legacy vehicle fleet, worth $2.6 trillion, suffers a material write-down in the value of its collateral. Finally, oil demand could peak much sooner than expected as electric robotaxi miles displace traditional auto miles. ARK estimates that robotaxis will put at risk the roughly $8 trillion of US public equity enterprise value in energy, autos, insurance, car rentals, and ride-hailing. Did somebody say Tesla? A wave of disruption is rolling through the auto industry and beyond. In our view, autonomous electric technology will cause a tidal wave of disruption not only in the auto industry, but in many other industries. If battery system costs decline, we believe electric vehicle prices will follow, triggering mass market adoption. At the same time, autonomous driving systems could boost the utilization and lower the cost of transport dramatically. ARK's research shows that robotaxis could cost consumers just 25 cents per mile, less than half the cost of driving a personal car, and at close to the cost of many public transit modes as shown below. As a result, autonomous taxis could become the dominant form of personal transportation in urban areas, obviating the need for many consumers to purchase personal vehicles. According to ARK estimates, US auto sales will fall nearly 50% from 17 million units today to just 10 million during the next 10 years. And we can see in these cost per mile figures here from ARK, the autonomous taxi there, cheaper than just about everything except for commuter rail, medium haul flight, commuter bus and commercial planes. Way cheaper than taxis, ride-hailing, private planes, new personal car, used personal car, short-haul flight, and ferries. Based on our research, also to decline is passenger air traffic. Robotaxis should offer more cost-effective and convenient door-to-door service alternatives to 1 to 3 hour flights, particularly when accounting for the drive to and from airports and the hassle of airport security lines. As a result, on the heels of the COVID-19 pandemic, ARK expects short-haul flight operators to suffer another blow, losing roughly 27% or $28 billion in revenues. Public transit, a $74 billion industry, is likely to suffer reduced ridership, placing additional strains on municipal revenues. Once the disruptors, ride-hailing companies seem to be in the crosshairs of disruption today. ARK does not believe that any of them will be competitive with autonomous technology providers, aka Tesla. If consumers shift from personal cars towards more cost-effective autonomous travel, they could begin to default on auto loans. The risks to auto loans, the asset-backed securities supporting them, and their underlying collateral are not well understood and could cascade through the global auto ecosystem. Now, this is an extremely important point from ARK. If you guys haven't looked into it, go check out a traditional automaker. Look at their balance sheet. Understand their business. They basically make no money selling most of their cars, make most of their money repairing and servicing these cars, and have huge amount of debt secured against internal combustion engine vehicles whose values this decade will fall off a cliff. It is not going to be pretty. Autonomous electric vehicles could depress the residual value of gas-powered used vehicles significantly. Loans totaling $1.2 trillion support roughly $2.6 trillion in vehicles on US roads today, the balance of which $1.4 trillion on consumer balance sheets. ARK anticipates that both consumers and lenders will have to write down these auto assets, casting a pall on auto-backed securities. Auto insurance rates could also plummet. According to our research, not only will robotaxis be less expensive than personal transportation, but they will also be much safer than human-driven vehicles, reducing accident rates by more than 80%. As robotaxis take to the roads, ARK estimates that roughly 57% of all automotive miles traveled in the US will be autonomous in the next 10 to 12 years, and that non-autonomous miles traveled will drop by nearly 40%. Did someone say Tesla robotaxis? If autonomous travel gains traction, traditional auto premiums, excluding autonomous vehicles, could drop roughly 55% from an expected peak of $266 billion in 2023 to $122 billion by 2030. Moreover, insurance providers could lose their most valuable customers first if young drivers become early adopters of autonomous technology. We believe traditional automakers and their dealer networks are in grave danger. The transition to autonomous electric platforms could create a winner-takes-most industry thanks to the massive amounts of data necessary to create autonomous driving platforms. As a result, the industry is likely to consolidate, with the survivors being those with successful autonomous technology and/or electric vehicle platforms. Did someone say Tesla again? Auto dealerships could also become casualties as service, financing, and insurance account for roughly 70% of their gross profits as shown below. With much lower maintenance expenses relative to gas-powered autos, EVs are likely to eat into dealer servicing business at the same time that default rates hit their financing businesses. Traditional auto manufacturers have significant balance sheet exposure to this disruption given the inexpensive financing they have provided to encourage sales. If auto loan delinquencies and defaults continue to rise, not only could dealerships go bankrupt, but automakers could lose both their distribution networks and their ability to stimulate sales with bargain basement financing. Now, this is a seriously scary thing to be looking at if you happen to be a car dealership. Look at this in terms of gross profit. Financial and insurance, so financing vehicles, car insurance plus parts and service, make up 3/4 of their gross profit. This is about to disappear. This will not be pretty. Finally, we believe the $4 trillion oil industry powering gasoline guzzlers has seen its brightest days. Battery system cost declines could lower EV sticker prices to levels below those of their gas counterparts during the next 2 to 3 years, stimulating EV demand to levels well above current forecasts. While the EIA forecasts EV penetration of 2% in 2022, for example, ARK would not be surprised to see 20%. Today, the capacity utilization of a personal car in the US is less than 5%. 10 times less than the 50% we anticipate for robotaxis. Although we believe EVs will account for roughly 15% of the installed base in 2025, electric miles could total roughly 40% of total passenger auto miles traveled. Consequently, oil demand has probably peaked as shown below. ARK believes the market has not discounted adequately the robotaxi disruption likely to upend the traditional world order in transportation. Tallying up the risk to airlines, public transit, ride-hailing, insurers, automakers, auto dealers, rental companies, and oil, ARK estimates that roughly $8 trillion of enterprise value in the public markets is at risk. In other words, long before dealers sell their last gasoline-powered car, we believe robotaxis will disrupt a dozen industries, destroying a meaningful percentage of portfolios tracking the broad-based benchmarks. Here we are looking at approximately $8 trillion of disruption just due to robotaxis. Ride-hailing, airlines, insurance, autos, dealers and rentals, plus the energy sector. This is enormous. So I hope you guys have found this video insightful. There's a link in the description to the full report. I highly recommend you guys check it out. I'm a really big fan of ARK Invest. Their research and analysis aligns very closely with my own way of viewing the future, disruption, technology, innovation, and of course, where I invest my money. This report is a warning to those who still have 1 or 2 feet in the old world. It's not going to work. Value investing is dead. Bricks and mortar retail is dead. Linear television, dead. Rail transport, dead. Car ownership, dead. To sum this one up, I'll just leave you with a thought. If your entire stock portfolio isn't comprised exclusively of companies who disrupt and innovate for breakfast, lunch and dinner, rip you. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you're in the US and you'd like 3 free stocks, check out the link in the description to WeBull. Open a new account and fund it with $100 and you'll get 3 free stocks, 2 of them valued up to $1,600. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. PS, if you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.